Mark, I got to say, when you have calls like that about the idea that we could see a plunge in economic activity, you wonder why markets are as optimistic as they are. What exactly are markets pricing in terms of when things get back to normal?
The markets are very optimistic right now. They might be front running the Fed a little bit, and I think they're looking at a robust recovery that just quite has not yet happened. I think we're forgetting about the collateral damage that's going to be on Main Street. Economic growth in this country is on the margin. Banks lend when they're comfortable. People bid up. Investors bid up risk premiums when they have a high risk appetite and return those multiples to what we saw just a few months ago. And we don't have that right now. We're going to have a different economic system of sorts where banks are going to require more collateral. They're going to not lend into these strip malls and on Main Street. Restaurants are not going to open up as quickly and as easily as they have been. And I think there's going to be a drag that hasn't been fully factored in, and I'm not in the camp that this is going to be a rosy, robust recovery. I think we will get one, but it's going to be more sluggish than these optimistic forecasts are outlining.
So when you say sluggish, what exactly does that mean? Does that mean in the third or fourth quarter of 2020? Does that mean in the first half of 2021, second half? What exactly does that play out like?
It's going to be a slow rollout, and it's going to be deliberate. It's going to be industry by industry, and it might even be region by region. The virus has not spread throughout the country. We hope it doesn't, but if it does, that would be another factor. Just because we're having slowdowns in what were hotspots doesn't mean others are not going to flare up. I'm really concerned about what's going to happen to bank lending standards, how aggressive or how interested they're going to be. I think this PPP loan program is going to boost the earnings for community and regional banks, at least a shot in the arm for those that really need it. But I think on an ongoing basis, they're going to be struggling more with loan workouts and reevaluating their collateral and relationships with small borrowers in the hundreds of thousands or in the millions. And I don't think we understand how economic activity slows when banks slow, when every loan application takes twice as long or longer, and when banks require higher covenants and more collateral. What a drag that is on the economy.
So the consensus right now, as much as there can actually be a consensus given what we don't know, is that energy, industrials, retail/consumer discretionary are going to be the worst earnings declines this earnings season. Meanwhile, tech and comm services going to hold up the best along with utilities. Yep. Does that kind of jive with your view overall for how you should position?
That absolutely does. We're fans of the technology space right now. Communication services, we've been talking about that, and that's where we want to overweight and allocate. Energy is another headwind. I think another mistake we're making is we're isolating coronavirus and the markets as if it's a one-to-one correlation, and those are all the data points that matter. Look, we have a huge energy glut. That's going to be a drag. It's going to be a drag on U.S. production. It's going to slow economic growth in huge areas of this country. It's also going to negatively impact the high-yield market, notwithstanding what the Fed does, what surprises they have in the bond buying. So that'll be another drag.
Sure.
So I think what you outlined there is a good blueprint. We're optimistic on some tech stocks. We are investing capital. It is on the growth side. It is on the economy of tomorrow. But when we look at drags, we see energy at the top of the list, and I think that's a good call.